This video will give examples of careers in precious metals using statistical analysis, finance, accounting, and business. Precious metals are traded around the clock, and prices are often very volatile. The market forces of supply and demand are magnified by speculation to create great volatility in precious metal prices for a variety of reasons. Mining companies, manufacturers, consumers, recyclers, and refiners, as well as financial lenders and brokers of precious metals, desire a way to protect themselves from these great price variations. These businesses all rely on their income based on the services they provide or products they produce. They must manage their precious metal inventories to prevent price variations from causing them to lose money. They also need to have a way to establish prices when precious metals containing products are bought and sold. The need to manage and reduce the risks involved with price variations and the timing of transactions involving the buying and selling of precious metals is the reason the financial metal markets exist. Exchanges have been created to regulate and provide an efficient way for precious metals to be bought, sold, and traded on spot, which is the current price, fix, which is a benchmark price set periodically, or future price tied to a specific date in the future. Unlike other commodities like agricultural products and fuel, precious metal values have historically been linked directly to currency values. This is no longer the case. Gold and silver have historically been recognized as both a currency and a commodity. Platinum and palladium have also been used as a currency in very limited amounts, while the remaining precious metals are much rarer and priced solely on a commodity basis. All precious metals are now priced as commodities with pricing variations based on specifications such as purity and form. Bullion bars from exchange-listed refiners have met certain standards which create an efficient trading system. They can be transferred between parties without reestablishing the purity with each transaction. Gold is the metal that is most closely associated with currency, as governments historically have set official prices and maintained physical gold reserves to back their currency. Maintaining the price stability of gold was so important that in 1961, 8 countries formed an international gold pool to help stabilize the international market-driven price of gold. They would buy gold on the open market to prop up the prices when the demand fell off compared to supply. When the demand was greater than current supply, they would sell gold to prevent the prices from increasing. This was designed to act as a type of buffer by absorbing the variations in the market-driven supply and demand. Various international market forces ended this gold price stability system in 1971. The U.S. Federal Reserve Bank officially ended the official pricing system for gold in 1973, and gold was effectively demonetized by the U.S. government by the end of 1974 when the ban on private holding of gold was lifted. Gold then became openly traded on a number of worldwide commodity exchanges with the prices driven by supply, demand, and speculation. Silver, platinum, and palladium are also exchange traded with millions of dollars of physical metal and future contracts changing hands around the clock each day. The precious metal exchanges provide various ways to buy and sell precious metals on either current or future prices. These exchanges and the manner in which they work will be explored in our next videos. The International Precious Metals Institute promotes the education and advancement of precious metals technology and business. IPMI is an international association of companies committed to providing technical resources and educational materials, including a series of videos presenting examples of precious metal applications and a variety of interesting and rewarding career opportunities.